the pitfalls? Why is it such a sensitive thing for the Fed chair and the president to meet?
Because the Fed is independent, and it's important for the public and for market participants to understand that the actions that the Fed takes are purely in response to its congressional mandate of maximum employment and price stability. There is some history of presidents trying to influence the Fed, and reportedly Nixon influenced Arthur Burns. So it's important for the sake of the Fed's credibility and confidence in the institution.
Right. So why meet at all if you have those concerns?
Well, the president is, of course, concerned about the economy.
Right.
And it's very natural for the president to want to hear the Fed chair's views on the economy and to understand that thinking.
You talked about a history of criticism of presidents of the Fed. There's pretty recent history of that. You must see the comments that President Trump has made about the Fed and the Fed chairman. Do you think, oh, wow, I'm glad that's not me? Or what is your sense of whether or not, of the propriety of that, really?
Well, I think a president has a right to express views. But there was a long history. I think it began with President Clinton, went through the Bush and Obama administrations of absolutely no comments by the president on the Fed. And, of course, throughout, there were always communications between the Fed and the White House. I had regular meetings with Secretary Lew and Secretary Mnuchin. I know that Chair Powell also has those meetings. So there is ongoing communication with members of the president's economic team and occasionally the president about the economy. But it is important for the Fed to be viewed as independent, and I worry that the comments threaten public confidence.
Let's leave the politics behind and talk about the economics right now. In December, the market seemed like they were sending a very strong signal that the economy was going to turn down this year. And the economic data kept coming in strong. Have you been in a situation like that? How do you handle the kind of market signal versus the economic data signal? What's the right one to believe?
Well, the economic data signals are important, but to some extent they're backward-looking. And I think the markets tend to focus on what they see coming down the pike. And it's important for the Fed to be doing the same thing. So far, the economic data for the United States is solid and strong. We've got, as you know, about the lowest unemployment rate in 50 years, continued solid job performance, low inflation. And my own view is that well, we've long expected growth to slow in 2019 relative to last year, which probably will come in around 3% or more. And we're seeing signs that the economy is slowing. I still expect the most likely outcome is solid growth in 2019. But there are downside risks.
What risks do you see, and how do you assess them?
Well, we are seeing slowing global growth. The data from China have been reasonably weak, and the European data has also come in weaker than I think had been expected. So there are those risks. There are risks stemming from trade policy, from Brexit, and uncertainties around various political decision-making. We've also seen, of course, a tightening of financial conditions. And for a long time, as the Fed raised short-term rates, indices of overall financial conditions were moving in the other direction. That's now changed, and we are seeing a tightening of financial conditions. So there are some things pulling down growth and less support this year than last from fiscal policy. But consumer spending is still 2/3 of all spending in the U.S. economy, and with slightly higher wage gains and strong job market performance, low debt burdens, I think consumers are in good shape to carry forward growth in 2019.